Welcome to Talk Tickers. We dive deep into earnings calls, pulling out the signals that matter for your investments.
And today we're digging into NRDY Incorporated's Q1 2025 call. Lots to unpack there.
Definitely. Let's start with the headline numbers. How did they actually do in Q1?
Well, it's a bit of a mixed picture. They reported revenue of $47.6 million.
Okay.
Which actually beat their own guidance. They'd guided $45 to $47 million. So, a beat there.
But I sense a butt coming.
Yeah. But that's still an 11% drop compared to last year. Q1 2024 was $53.7 million.
Right, okay. So beating expectations, but still down year over year. What's driving that difference?
The main things pulling it down were fewer learning memberships overall compared to last year, and also lower revenue from their institutional business.
Got it. Fewer members.
But, and this is the important counterpoint, they saw really strong growth in ARPM. That's average revenue per member per month.
ARPM. Always a key one for subscription models. How strong was that growth?
Pretty significant. It hit $335. That's up 14% year over year, and actually up 11% just from the end of last year.
Wow. Okay, so the members they have are paying more or using more valuable services?
Exactly. It points to a shift towards higher frequency plans, and they also put through some price increases during the quarter.
And what does that ARPM translate to in terms of overall run rate?
At the end of the quarter, that $335 ARPM translates to an annualized run rate of about $163 million just from those learning memberships.
That's a substantial base.
And another key thing, they flagged their monthly recurring revenue from learning memberships. It actually inflected positive year over year in March.
Okay, that is interesting. A potential turning point there after declines.
Seems like it. A shift from being a headwind to potentially becoming a tailwind for growth.
All right, let's switch gears a bit. What about the institutional side, varsity tutors for schools?
Yeah, so that part brought in $9.4 million, which is about 19% of the total revenue.
Okay.
They signed 90 contracts in the quarter, worth about $4 million in bookings.
And how many of those were paid versus, say, free trials or pilots?
Good question. About a third, 34% of the contracts were paid. And those paid contracts made up 19% of that total booking value.
So still a decent chunk relying on potentially converting free users later.
Seems that way. Some traction on paid, but maybe more work to do there.
Okay, let's talk profit or lack thereof. How did the margins in EBITDA look?
Right, so gross profit landed at $27.6 million. That's down 24% from last year.
Ouch. And the margin itself?
Yeah, the gross margin was 58%. That compares to 68% in Q1 last year. So a pretty noticeable drop.
What's the reason they gave for that compression?
They pointed directly to investments in incentives for their tutors, their experts.
The expert incentives. We'll need to circle back on that.
Definitely. That and also just higher usage of tutoring sessions by the members they have.
Okay, so higher costs associated with delivering the service. What about adjusted EBITDA?
On that front, it was actually a bit better than expected. The non-GAAP adjusted EBITDA loss was $6.4 million.
Better than expected how? What was their guidance?
They guided for a loss between $6 and $8 million. So $6.4 million is at the better end of that range. Last year, Q1 was basically break even, positive $24,000.
And why the outperformance versus guidance this time?
They mentioned better marketing efficiency, so lower customer acquisition costs and just general cost management across the board.
Okay, managing costs well. What about their CAC situation?
Debt. They look pretty solid there. Ended the quarter with $44.9 million in cash and equivalents, and importantly, zero debt.
Zero debt is always nice to see. And looking ahead, what's the guidance for Q2 and the full year?
For Q2, they're projecting revenue between $45 and $48 million, so kind of similar to Q1. For the full year, they actually raised the low end of their revenue guidance. It's now $191.5 million to $200 million.
Raising guidance, even just the low end, is usually taken positively. What about profitability guidance?
For Q2, they expect the adjusted EBITDA loss to be between $3 million and $6 million, so potentially improving from Q1.
And the full year?
They reaffirmed the full year adjusted EBITDA guidance, positive $8 million to $18 million.
So still expecting a profitable year on that adjusted basis?
Yes. And crucially, they expect to hit positive adjusted EBITDA and positive operating cash flow in the fourth quarter, Q4 of this year.
Okay, that's the target. Profitability by year end and cash balance.
They project ending the year with $35 to $40 million in cash. So burning some cash through the year, but ending with a decent cushion.
Right, that gives us a good snapshot. Let's dive deeper now. You mentioned the revenue dip was partly offset by that big jump in ARPM. Can you unpack that dynamic a bit more?
Sure. It really looks like a strategic choice. They seem to be okay with having fewer members overall, at least for now, if those members are, more valuable.
Oh, so
By focusing on getting people onto higher frequency plans where they use more tutoring hours and implementing those price increases we talked about.
so quality over quantity, in a sense.
Kind of, yeah. And it seems to be working on the revenue per member side. Plus, they mentioned retention is improving for newer groups of customers.
Why is retention getting better?
They think it's down to improvements they've made in the user experience and, importantly, those extra incentives we keep mentioning.
Right, the incentives. Let's really get into that. It hit the gross margin, but what are the positive effects they're seeing?
Well, they flag several positive signs, things like learners getting their first session faster.
Okay, quicker engagement.
Yeah, and more sessions happening in the first 30 days. Also, tutors are doing more sessions on average, and fewer tutors are leaving the platform.
Lower tutor churn. That's usually a good sign for quality and consistency.
Exactly. And all of this, they say, is leading to better customer retention, too.
So the bet is that investing in tutors now, even though it hurts margins short term,
Will pay off long term through better service, happier customers who stick around longer, and eventually, they believe, allow margins to recover.
what's the target for margin recovery?
They expect sequential improvements quarter by quarter as more new customers come in at the higher prices. The long-term goal they mentioned is getting back above 70% gross margin by 2026.
Ambitious, getting back to those
Yeah.
historical levels.
Okay.
Okay. Another big theme was AI. Live plus AI. Sounds like a major push.
Oh, absolutely. They're investing heavily here. It's not just one feature. They're weaving AI tools throughout the entire platform for learners, families, teachers, institutions, everyone.
What kind of tools are we talking about? Give me some examples.
Sure. So things like AI helping with the tutoring itself, providing insights after sessions, AI involved in their 24/7 chat support alongside humans,
Okay.
AI enhancing live classes, and even an AI co-pilot to help tutors.
Pilot for tutors, interesting.
Yeah, and they specifically highlighted generative AI that creates automatic transcripts and summaries of tutoring sessions.
Session summaries, that sounds useful.
Apparently very useful. They said these summaries link directly to key moments in the video recording, which is great for review. Feedback has been over 95% positive, they claimed.
And that's helping retention too.
Yes, they mentioned it specifically helped with retention for their institutional clients.
What else is coming on the AI front, especially for schools?
They talked about developing AI for dynamic exit tickets, quick checks for understanding after a lesson, and better analytics for schools to track student progress across groups.
And AI creating content.
Yes, also using AI to generate customized lesson plans and practice problems aligned to standards for both their tutors and for teachers using the platform in schools.
So AI isn't just a product feature. It sounds like it's also boosting their own efficiency.
Exactly right. They've used AI productivity tools and better workflows to cut their headcount by 16% since the end of last year.
16%. Wow. That's quite significant.
Yeah. And they think there's more room for AI to streamline things, improve the customer experience, and cut costs further.
Did AI help with that marketing efficiency you mentioned earlier? The lower customer acquisition cost.
They attributed the 19% year-over-year drop in consumer CAC to marketing efficiency gains. It's very likely AI analytics played a role in optimizing that spend, though they didn't explicitly detail it in that context.
Makes sense. And you said they were more cautious with spending on the institutional side.
Yeah, they mentioned moderating investments there, likely due to, the uncertainties around school funding cycles right now. It's a bit unpredictable.
So how does that caution affect their strategy for varsity tutors for schools? Are they pulling back?
Not pulling back, but shifting focus. The push now is towards getting schools to pay for access, particularly for the new Live Plus AI platform features.
So the free offering might still exist, but the really cool AI stuff costs money.
That seems to be the plan. They need to show value to justify the upgrade. They did say early signs, and the sales pipeline for the paid platform look encouraging, despite the funding headwinds.
What specifically about the AI seems to be resonating with schools?
Things like those automated sessions summaries we talked about, and other tools aimed at boosting teacher productivity. Anything that saves teachers time is usually popular.
Definitely. Okay, let's circle back quickly to that recurring revenue inflection point in March. You said it was driven by several things.
Yeah, it wasn't just one silver bullet. They mentioned improvements to onboarding new customers, the focus on higher value memberships, better matching of students and tutors.
The algorithm improvements.
Right. plus the tutor incentives making the experience stickier, and new features like those AI summaries adding value. It's kind of a combination of factors starting to bear fruit.
And they expect that momentum to build through the year.
That's what they indicated. They anticipate that year-over-year growth in recurring membership revenue will keep accelerating, which should really help the total company growth picture.
And that ties back to the ARPM growth as well, presumably. What's the outlook there again?
Yeah, they expect ARPM to keep climbing. The projections they shared were reaching $345 by the end of Q2, then $360 by end of Q3, and breaking $370 by the end of this year.
Okay, steady climb. Shows confidence in their pricing power and the value members are getting.
It certainly suggests that, yes.
All right, this has been a great deep dive into the quarter. Now for our favorite segment. This is not financial advice. Time for some outrageous but plausible trade ideas based on what we've heard. You go first.
Okay, let's call this one the AI education arms race. We heard NRDY talk a lot about AI, their Live plus AI strategy. We know AI in education is a huge theme, even getting attention from policymakers.
Right.
So the trade idea, maybe go long on companies, potentially including NRDY itself, that are really pushing the envelope and successfully integrating AI into learning platforms. Think personalized learning, AI tutors, advanced analytics.
Okay, long the AI education innovators. What's the other side of the trade?
Simultaneously, you could consider shorting traditional education players, maybe textbook publishers, maybe older tutoring models, companies that seem slow to adapt or getting disrupted by these AI advancements.
So betting that AI really shakes up who wins and loses in education.
Exactly. The pace of change could be really fast. Disclaimer. Of course, this is not financial advice, just a speculative idea based on the call.
Understood. Okay, my turn. Let's call mine the upskilling imperative play. NRDY mentioned helping develop workforce skills for an AI future, integrating AI skills even into K-12.
Preparing for the future workforce.
Right, so the trade, consider going long on companies focused on professional development and upskilling, especially online platforms teaching AI literacy, data science, coding, those kinds of future-proof skills.
Makes sense. Continuous learning is becoming crucial. What's the short?
Maybe short companies that rely heavily on entry-level human jobs that are, highly susceptible to being automated away by AI. Think certain types of data entry, customer service, basic content generation, maybe.
Interesting. So betting on the need for humans to adapt and learn new skills while betting against roles that might become obsolete.
Pretty much. The demand for upskilling could boom as AI reshapes industries. Disclaimer. Again, definitely not financial advice.
Yeah.
Purely a thought experiment based on today's discussion.
Two very different angles, both rooted in that big AI theme from the call.
Indeed. Well, that wraps up our deep dive into the NRDY Incorporated Q1 2025 earnings call. We've unpacked the results, the big push into AI, the strategic shifts, and that path they've outlined towards profitability.
Hopefully this gave you some valuable insights into what's happening with the company and the trends they're navigating.
What stood out most to you? Are there still questions lingering? As always, we encourage you to do your own homework and dig deeper.
Join us next time on Talk Tickers, where we'll break down another key earnings call.
And remember, while we went deep into the information from the call, this was purely for informational purposes. It should absolutely not be taken as financial advice.